EQ Bank is a virtual bank that has been taking the Canadian banking sector by storm. However, we need to take a hard look to find out if they are the real deal. Fasten your seatbelts, folks. This is going to be a good one. EQ Bank is a relative newcomer to the banking sector, as they were launched, well, not that long ago in 2016 by Equitable Bank, which is Canada's 9th largest independent bank, and they have been around, well, since 1970. EQ Bank sets themselves apart from the big banks by offering high-interest savings accounts and those fantastic GICs. Being virtual, it has allowed EQ Bank to offer services with much lower, or in some cases no fees, because they do not have a lot of that, well, that overhead generated by a physical presence. They have grown beyond their original products and have added more savings products, a cash card, easy money transfers, including those international ones, and mortgage offerings. This is a bank that is starting to get better, and they have been moving in the right direction. I am excited to see what they come up with next. Join the conversation. Let us know in the comments if you invest or bank with EQ Bank. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. I switched to EQ Bank a few years ago, and I am still happy with that choice. As a customer, EQ has been fantastic, and every time they add a new feature, I am pretty much overjoyed. Of course, they are not perfect yet. I would, for example, love to see a cashback credit card added to their lineup of products. I also wouldn't mind seeing them eventually add a commission-free brokerage, though I will say that credit card is probably a more realistic wish. Of course, the customer experience, well, it does not always match the investor experience. To get down to the nitty-gritty, we need to look at their fundamentals, and we can't do that without the help of our good old buddy, Mr. Math. We will, as usual, begin with some surface data. Their current value comes in at $85, right on the nose. They got a market cap of $3.12 billion, and their beta, it is a little volatile at 1.67. Their earnings per share come in at 9.31. That's pretty healthy. And they have a price to earnings ratio of 8.89. The average in their sector, well, that comes in at 11.5. If we look at some of the smaller banks, Canadian Western Bank has a PE of 8.96, and Laurentian Bank comes in at 6.53. Their price to book ratio, that comes in at 1.20, and the average amongst their peers in them smaller banks comes in at 0.8. Their return on equity, it comes in at 14.70%. This initial data looks perfectly okay to me, so we will dig a wee bit deeper and see what they have going on in that cash department. When it comes to revenue, their revenue comes in at $959.38 million, and they have in earnings $345.80 million. But now get this, their projected earnings is 16.63% per year over their next 5 years. Holy banana bread, that's not bad. And just to put that into perspective, just in the previous year, they grew by 17.2%, which is absolutely phenomenal. They have a very nice looking profit margin of 36%. Now, their free cash flow, it is negative $1.88 billion, and their operating cash flow is also in the negative at negative $1.81 billion. You got to keep in mind, this overall negative cash flow is not necessarily bad, as it is a sign of, well, two things. One, it is showing that they are flowing it back into their expansion, and two, they are issuing out more loans to customers, which can also impact this data. Sometimes a quickly growing bank is gonna have that negative cash flow. There's not much you can do about that. When we look at their fair value, the current value we used in the calculation was at $82.02, and after we're applying a discounted cash flow model, we do get a fair value of $210.65. That puts them undervalued at 61.1%. Now, keep in mind, they've already moved from that $82.02 up to $85, so they're undervalued probably maybe about 58%. Nonetheless, there is a lot of room for them to grow, and I have a feeling they might just take me up on that. In fact, if we look at a one-year projection, most analysts are predicting $99.38. That's 21.2% over the next year. That's pretty darn good. So other than the negative cash flow, I am still liking the overall feel for these numbers, and like I said, that negative cash flow may not be a bad thing. So we will, of course, peel back another layer and let's dive into those returns. When it comes to dividends, they're not a huge dividend payer. They do have a yield of 1.951%. That's a quarterly dividend of 40 cents per share. Their payout ratio, super sustainable at 14.61%. Switching to their growth, For the 3-year, their price rose from $50.15 all the way up to $85. That is a return on investment of 69.49%. Factor in those dividends, we get a total return of 75.94%. And that's not too shabby. Let's take a look at the year to date though. In 2023, their price rose from $56.77 to $85. So that is a return on investment of 49.73%. And factoring in the dividends, we do get a total return for this year of 51.66%. Holy banana bread, that's great. For a bank, these returns are absolutely stellar. I love what I am seeing, and this has me a wee bit excited for what the future may hold for EQ Bank. However, we still need to dive down a bit more and look at their debt. EQ Bank has a total debt of $17.97 billion, and their total equity comes in at $2.72 billion. That gives us a debt-to-equity ratio of 660.7%. This is a big number, and it definitely makes me pause for sure. However, if there is a silver lining to this debt, it is that they have been reducing this debt-equity ratio over the past 5 years from 663.9% to 660.7%. Yes, that is not a lot, but it is a move in the right direction. They do have cash and cash equivalents, and that totals up to $2.01 billion. Let's take a look at the short term. On the short term, they have assets of $3.11 billion and liabilities of $33.51 billion. Absolutely, I do not like that. That's not ideal at all. On the long term, it looks a lot better. Their assets come in at $50.21 billion, and those liabilities come in at $17.09 billion. Overall, EQ Bank's debt situation is not ideal, to say the least. However, with them growing as much as they have, that does create debt, as it is usually what is used to finance their expansion. If they continue growing as projected, we will see this debt come down over time. Obviously, with a negative cash flow, we don't have coverage on the debt, and we certainly don't have coverage on the interest on the debt. However, I'm pretty sure EQ Bank has no intentions of defaulting on that debt, so I'm not too worried about that. Okay, we've come to the point where we do need to ask, what is that final verdict? This is a stock that is poised to do very well, but the debt may keep some investors on the sidelines watching what could have been in their portfolio. I, for one, hate seeing a lot of debt on a company, but I do always look at the sector, as some sectors will have lots of debt. The banking sector is one of those sectors. With banks, they carry a lot of debt, as that is their business model. If I deposit money in a bank, they then owe me that money. So that is part of the debt that they carry. However, that is a very low interest debt, and the likelihood of everyone cleaning out their accounts is actually very slim. In fact, regulations state that a bank has to have an 11% capital against asset to cover people moving money out. EQ holds 13.3%, so they are well positioned on that debt. Also, keep in mind, their expansion has been on overdrive, and that is not going to change anytime soon. They will have higher debt as a result, and that is something that is not so bad when you realize that is only going to power the stock's growth. Growth-wise, they have outperformed the market and the sector, and that is a holy banana bread level of awesome. This is a great option for growth and total return investors. It is also good for short to long-term investing. I really don't have a lot of bad to say about this stock. So who is this stock not great for? Well, if you are a fully passive income investor, the dividends will not, well, they're not going to excite you. Outside of investing, if you want to become a customer of EQ Bank, there is an affiliate link below that gives you and the channel a bonus when you sign up. Add to the negative cash flow today. As usual, if you are interested in EQB, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Keep the learning going. Watch my video on total return ETFs linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.